Hello, welcome. If you're new to Forex trading and you're wondering what is leverage, you're asking yourself what is lot size, you're in the right place. Today I'm going to take you on the topic, what is leverage trading. Okay, previously I have done the video where I talked about what is Forex trading, where is Forex traded, what is Forex traded, who is Forex broker, how to start trading Forex, and that was part 1, and this is part 2 where I'm going to be talking about what is leverage, what is lot size, and what is stop loss and take profit. So if you're a beginner, I presume this video will do a lot of justice, or you will learn a lot from this video. Please don't forget to subscribe to this channel so you won't miss any video. I drop back-to-back content on Forex trading, back-to-back content on e-commerce website, how to create mobile app, finance, tech, etc. So let's dive into the topic without saying much. Alright, if you've been wondering what is leverage, you have been hearing the term leverage. If you're in Forex trading, this shouldn't be a new term. It shouldn't be a new term. At least you've been hearing leverage. So what is leverage? So leverage, I'm going to give a definition, a dictionary definition of leverage, and then I'm going to give you a layman definition of leverage so that you're going to understand what is leverage. So what's leverage? Leverage refers to the use of borrowed money to increase the potential return on investment. The use of borrowed money to increase the potential return on investment. Leverage allowed traders to open positions that are larger than the actual amount of money they have deposited in their trading account. Remember, we are talking about Forex trading, not any other kind of investment. So now we're talking about borrowed money. Where are you borrowing the money from? Who are you borrowing from? So if you had seen my part 1 video where I talked about who is a broker, so you should be understanding who you are borrowing the money from. So now you're borrowing the money from a broker, not your family, not your friends. You're borrowing the money from a broker. So a broker is people, a company that gives you leverage to trade the Forex market. Understand? So now let me give you a layman definition of leverage. For instance, now you want to buy a land for business. You want to buy a land for business. You want where you build, maybe for real estate, you want to sell it out and make money. So you don't have, and the land you are planning on acquiring maybe worth 100 million, and you don't have the 100 million, and what you currently have is 5 million naira, or rather 10 million naira. So now the broker will say, come, bring your 10 million naira, deposit it, and we'll give you leverage. We'll borrow you money. We'll borrow you that 100 million naira, but let's hold your 10 million naira. You do business, and then if you do business, you make losses. They will take both the 10 million naira and your own, and they'll take both the 100 million naira and your own 10 million naira. Understand? But if you make profit, they are still with your 10 million naira. Your 10 million naira is still active. You can still withdraw it when you want. Understand? You can also withdraw your profits too. But when you make losses, they take both your 10 million naira and the 100 million naira they give to you. So that's leverage. Now remember, I told you in my previous video that your money cannot trade Forex. Normally Forex are for the big boys, the big companies like the CBN, etc, just like that, CBN of every country. But in Forex trading, the broker has made it easy for you to be able to deposit $5, $10, $200, $100, and you are able to have access to the Forex market. You get, what can your $100 do in Forex market? So that is what the broker has been able to help you to achieve. So they give you leverage. They make you that your $10, that your $20, that your $200, that your $500, that your $1,000 looks like for instance, your $100 looks like $100,000. They have types of leverage. They have leverage 1:1, 1:100, 1:200, 1:300, just like that, So 1:100 means your $100 magnified it, looking like a $1,000. I mean $100,000. Understand? That is 1:100. So on and so forth. So I think I thought I saw an illustration of how leverage works. Okay, maybe in my next video where I'm going to be expatiating, going deeply into leverage, how to choose a good leverage, how to take advantage of leverage. In this video, I'm just going to talk about just leverage, just touch it lightly. Then I'll talk about what is lot size, then what is stop loss. I don't want to really go too deep so that the video will not be too long. So, and also if you're a beginner and if I start going too deep, if you're not following up, you might get missing. Understand? So now, leverage is a fundamental concept in the realm of trading investments. It amplifies your potential gain, but it also magnifies your losses too. So imagine you using leverage of 1:300. Understand? 1:300, whereby if you are making profits, if you are on a trade, it's easy to enter profit. Also, if you are using if you are on the loss, the losses magnifies, the losses keep increasing, And also, when you are using a small leverage when your other friends are open the same trade with you, they are in profit, you are still yet in floating loss because the leverage you use is very small, or is still small. So, but I'm going to do a video where I will teach you the right leverage to use. So I've already talked about what is leverage and how to use the leverage. So how is leverage expressed? Leverage is expressed in ratios. And I've talked about 1:1, 100:1, 1:1, 1:2, 1:3, just like that. So it's expressed in ratio form. So we can't when you're talking about leverage, you have to talk about ratio. You get ratio. And I said your $100 looks like a $100,000, or your $100 looks like a $1,000, or your $100,000 looks like a $100,000, or your $100,000 look like a $1 million, just like that. So that is leverage for you. So now, what is lot size? What is lot size? If you just new to Forex and you don't know what is lot size, you've been hearing lot size. What does lot size means? Okay, let's dive into it. So a lot size refers to the smallest amount traded that you can place a trade. A lot size refers to the smallest available trade size that you can place when trading. I'm going to give you, as usual, I'm going to give you a dictionary definition of it and also a layman definition so that you can understand. So currencies are traded in lots, which are batches of currencies used to standardize the quantity of forex traded. A standard lot is 100,000 units of currencies. There are also smaller sizes available, not as many lots, micro lots, worth 10,000 and 1,000 units respectively. Okay, let me explain what is lot on a layman understanding. For instance, now you want to trade Euro USD. Remember I told you in previous video that we trade two things in Forex. We trade both currencies and we trade both stocks. So I'm talking about currency right now. So we want to trade currencies now, Euro USD for example, and then you want to place a trade. Of course, the first thing to do is, after you have analyzed the market, you have checked the market. So if you don't know how to analyze the market, please watch the video up here to learn how to analyze the market. And now you want to take a position I'm going to also do a video on position. Understand? So the next thing to do is, what lot size am I going to use? Again, am I going to use 0.001, 0.002, 0.003, or am I going to use 1.0 or 5.0? You know, when people are saying Forex is risky, it's determined on how you take your decisions, your lot size. You understand? The decisions you make in Forex determines if Forex will be risky for you or Forex will be profitable for you. So now, first and foremost, you cannot just start taking losses, enter a trade without knowing how volatile that pair is. Understand? Euro USD, GP USD, you know how volatile they are always. Understand? And if you understand the strategy of loss size, I'm going to drop a video where I'm going to talk about the strategy of loss size up here. Understand? So now you understand the strategy of loss size, the psychology behind lot size. So you choose your lot size wisely. So a layman definition is, you want to enter a trade, Euro USD. So you are saying, okay, do you know what? I'm going to enter this trade with 0.00 risks, 0.001 risks. And then another person will just say, okay, well, I have the appetite to take risks, so I'm going to enter this trade with 5.00. So if you are in profit, the person with 5.00 will profit more. You can see how big the loss size is, will profit more. The person with will profit more than the person with 0.001. But if you are also in losses, the person with 5.00 will be in massive loss than the person with 0.001. So that is a layman definition of loss size. So you determine what you want to risk. So what you want to risk in forex trading, it is determined by you. So the person think once you just enter the market, you start making losses. No. It doesn't work that way. You are the one to determine your losses. But they want to determine what you want to lose. So let's go down when we talk about types of losses. There are types of loss and lot size. We have the mini lot, we have the micro lot, we have the standard lot. So standard lot is when you are using 100, when you are using 10.0, 100.0. Understand? Mini lot is when you're using 10.0. Macro lot is when you're using 1.00, which I just talked about. 5.00 is more than macro lot. Understand? Okay, let's go down. A micro lot represents 1,000 units of any currency. A 1 pips movement for, I'm going to do a video where I'll talk about pips too, so watch out for that video. A 1 pips movement for a micro lot corresponding with a 0.10 charge. Let's just go straight into it. So okay, there is not where we talk about loss size here. So what I'm saying in essence that if you are using mini lots, we're talking about 0.001. That one is a mini lot. Then you're using a macro lot, we're talking about 1.00. If you're using a standard lot, we're talking about 100. Some broker don't even have 100. Some have 10, some have 20, some have 50. Understand? So those ones are standard lots. It depends on your account size. You take a lot based on your account size. So there, you don't go and use a $5 account and you go and use 10 points. The trade will not even trigger because it will tell you insufficient fund. Understand? So, and also to, even if you have $100 and you're taking 2 points, that is you're taking a micro lot, is too high. Understand? So if you're having $100, if I'm to advise you, the kind of lot size to use is between 0.5 and 0.1. That is the kind of lot size, the highest lot size you should be using. 0.5 stuff is aggressive. 0.3 to 0.1 is marginal. Understand? So but if you know your strategy very well, you know what to do in forex markets. I'm going to do a video on loss size strategy, so watch out for it. So you can increase your loss size and reduce your stop loss. You still make the same money, you still lose the same amount if in case you losses comes. So that's for loss size. The next thing we're going to talk about is stop loss and take profits. Now let me give you a layman definition of stop loss. Stop loss is you are on Euro USD buy. For instance, remember I said buy is an upward movement, sell is a downward movement, and then you say, okay, look, I want you guys to stop me. For instance, now maybe you are buying from here, just follow the cursor from here to here, and then you say, okay, since I'm buying from here to here, in case this trade does not buy, okay, let's just say here you are here, you say you want to buy and end here, so your stop loss is put my stop loss here. In case this trade change direction, instead of buying, you started selling and sell deeply, close me out. This is the minimum I want to lose. Maybe you have calculated from here to here, maybe it's $20 or $30, and I'm talking about dollars. It can be 20 pips, 30 pips, or 40 pips. Remember, also I'm going to do a video and link it up here where I will talk about pips. So he said, if this trade gets to this point, close me. I don't want to lose more than this. So you have $500. Okay, I want to lose just $20 out of this trade. I want to lose or just $50 out of this trade. Don't take more than $50. So that's where you put your stop loss. You calculate it properly. And also your take profit is, if this trade gets here just the way you got here, you didn't close, start going back again to this point. This is where I want to take my profits, my take profit. So once it gets here, once the trade gets here, let it close me. So in this case, when the trade got here and rejected, so the trade must have already closed you out from the market. So you see rejected and started selling again deeply, so you are on the safe side. So you see on this case now, where this is a sample of a trade I entered from. So this red line is my stop loss. I said, okay, close me out on this place. This is where I want to take my stop loss, and this is where I want to take my, you can see the arrow, this is where I want to take my take profits. Understand? So I'm saying, look, between this red zone, this is where my loss, my stop loss is. So if this trade goes above this line, please, this is all I want to take. This trade also goes below this line, should close me as well too. So that's what I said too. Alright, do well to watch my other videos. If you have not subscribed to this channel, please subscribe. See you in the next video, where I'm going to be talking about in the part 3, I'm going to be talking about how to choose a good broker, what is spread, etc. Alright, cheers.